The stock market is hitting record highs, and on the surface, the economy looks strong. But what if the real story is hiding in plain sight? History shows us that the biggest, most painful market crashes don't happen when everyone's pessimistic. They happen when the system is flashing critical red alerts that most people are simply choosing to ignore. These are the moments right before the floor gives out, when euphoria is actually masking extreme danger. In this video, we're going to skip the usual talking points. We're cutting through the noise to show you 3 undeniable signs that the next major financial correction could already be starting. These aren't just theories. These are real vulnerabilities that experts are tracking right now, based on historical patterns you won't hear about on the mainstream news. What's happening under the surface of the market is telling a completely different story than the headlines. The first, and maybe the most obvious warning sign, is the wild speculation and extreme concentration in the stock market. It's starting to look a lot like the dot-com bubble in 2000. Sure, indexes like the S&P 500 look healthy, but that strength is a mile wide and an inch deep. A tiny group of mega-cap tech stocks, the Magnificent Seven, have been responsible for the vast majority of the market's gains. As of early 2026, these 7 companies make up roughly a third of the entire S&P 500's value. Think about that. Just 7 companies are propping up an index that's supposed to reflect the health of 500 of America's biggest corporations. That's not a healthy, broad-based rally. It's a dangerously fragile market. When a market gets this top-heavy, the whole system is left incredibly vulnerable. If just a couple of these giants stumble, the whole house of cards could come crashing down. We're already seeing some signs of divergence, where the performance of this small group is separating from the rest of the market. A classic late-cycle warning. What's fueling this? A speculative mania around artificial intelligence. The story is that AI will unlock trillions in new wealth, justifying any and every stock price. We've seen this movie before. In the late 90s, the story was the internet. Today, it's AI. Companies are in a massive, debt-fueled arms race to build out AI infrastructure, with some projections showing that capital spending in the sector could blow past $500 billion in 2026 alone. This isn't just normal investment, it's a gold rush. And when that much money floods into one area so quickly, it creates a bubble. Valuations are hitting levels that give you dot-com era flashbacks, making these stocks incredibly sensitive to any slip-up. Moody's has even flagged an AI equity price correction as a key risk for 2026. A sharp downturn in these tech darlings wouldn't just be a stock market problem, it would tighten financing for the entire economy and hit everyone from startups to semiconductor firms. The second warning sign is hiding where most people never look: the private credit market. This is the new shadow banking system, and since the last financial crisis, it has ballooned into a massive multi-trillion-dollar industry with very little regulatory oversight. After 2008, new rules made it tougher for regular banks to make risky loans. But the hunger for that debt never went away. It just moved into the shadows. Private credit funds jumped in, lending to everyone from medium-sized companies to huge private equity buyouts. This market has exploded and is projected to hit an incredible $2.8 trillion by 2028. It's now a pillar of global finance, yet it operates in the dark, without the guardrails like stress tests and capital requirements that apply to traditional banks. And that's where the real risk is building. Because the market is private, it's opaque. We don't have a clear, real-time view of how good these loans are or who's on the hook if they go bad. What we do know is that a long stretch of high interest rates is putting massive pressure on the companies that took on all this debt. The cracks are already starting to show. We're seeing more and more reports of distress and defaults in companies financed by private credit, signaling that the strain of higher rates is causing real damage. These aren't just isolated incidents, they're canaries in the coal mine. The danger of contagion is huge. Pension funds, insurance companies, and even regional banks have poured money into this market, all chasing the high returns it promised. Moody's has warned about a scenario where this stress spills over, causing a system-wide panic. Sound familiar? It should. Before 2008, the risk was buried in complex derivatives and off-balance sheet tricks. Today, it's concentrated in this sprawling, unregulated private debt market. It has all the makings of the next subprime. The fuse is lit. The only question is how long it is. If you're getting value from this analysis and want to understand the real risks in the economy, take a second to subscribe and hit that notification bell. We're focused on giving you the unvarnished truth you need to navigate what's coming. The third, and maybe the most unavoidable warning sign, is the collision between runaway government debt and a crisis of confidence in the Federal Reserve. For years, the government could spend trillions of dollars it didn't have, all because the Fed held interest rates near zero. That party is officially over. The U.S. national debt is now soaring past $38 trillion, and the bill is finally coming due. The cost to service this mountain of debt is exploding. The Congressional Budget Office projects that net interest payments on the debt will blow past $1 trillion in fiscal year 2026. This isn't just some abstract number, it's a fundamental rewiring of our country's finances. In the first quarter of fiscal year 2026, interest payments already became the second largest category of all government spending, trailing only Social Security. Think about that. More of your tax dollars are now spent on interest for old debt than on our entire national defense. This kicks off a terrifying feedback loop called a fiscal debt spiral. As the debt gets bigger, the interest payments get bigger. To make those payments, the government has to borrow even more, which makes the total debt and the next round of interest payments even bigger. It's the fastest growing part of the federal budget, and it's on track to consume more and more of our economy. This brings us to the Fed. As of early 2026, inflation is still stubbornly hovering above the Fed's 2% target. But its ability to fight any new flare-ups is now severely handcuffed by all this government debt. If they raise rates much higher, they risk blowing a hole in the federal budget by making those interest payments completely unmanageable. And to make matters worse, a political storm is brewing over the Fed's leadership. The term for the current Federal Reserve Chair, Jerome Powell, ends in May of 2026. This is setting the stage for a nasty political fight over the independence of our central bank. If investors even get a whiff that the Fed is becoming politicized or losing its nerve in the fight against inflation, they could lose faith in U.S. bonds. If that happens, long-term interest rates would spike, slamming the brakes on the U.S. economy and triggering a potential crash in asset prices. The Fed is trapped. If it keeps rates high to fight inflation, it risks bankrupting the government. If it cuts rates to help the government's debt problem, it risks letting inflation run wild again. This is the definition of being caught between a rock and a hard place. So let's pull this all together. First, we have a stock market balanced on the head of a pin, propped up by a few mega stocks in a speculative AI bubble. Second, a multi-trillion-dollar shadow banking system that's starting to crack under the pressure of high interest rates, threatening to spread panic. And third, a government caught in a death spiral of debt, which has trapped the Federal Reserve and is destroying its credibility right when we need it most. While the mainstream news talks about market highs, these three red alerts are painting a picture of an economy that is way more fragile than most people realize. These aren't small, isolated issues. They are deep structural cracks in the financial system's foundation. History teaches us that moments of wild euphoria and hidden debt always end in a painful reckoning. The only question is what lights the match. It could be a bad earnings report from a tech giant, a big default in the private credit market, or a loss of faith in U.S. debt. When the correction finally hits, it will be fast, and the people who are distracted by the headlines will be the ones who get hurt the most. The time to pay attention is now.